Everyone has their eyes glued to the Federal Reserve's balance sheet, and they're missing the real story. The money supply is rising again, and it's rising quickly. But it's not the Fed doing the printing this time. The banks are doing it for them, and it's accelerating right as the government is needing to roll over trillions in debt. This is a chart of the money supply in the United States. Back in 1983, the entire US money supply was only $2 trillion. And it wasn't until 1997 that it had doubled to get to $4 trillion. But by the financial crisis, it had doubled again to hit $8 trillion in 2008. And the money printing that started in 2020 got us to our next double to hit 16 trillion. And now just 5 years later, we are sitting at a money supply of $21.8 trillion, which is over 10 times what it was back in 1983. Zooming in on just the last 5 years, you can see that we did have a couple of years where the money supply declined following all the money printing that happened in 2020. But that ended in 2023 and the money supply has been rising since. And zooming in on just the last year, we can see that trend has been accelerating lately. Now I've changed the chart. Instead of showing the absolute level of the money supply, we are now looking at the year-over-year percentage change. For example, in 1995, the money supply had basically not changed from the year before. However, in 2012, the yearly change in the money supply was 10% from the year before. We had a record high in 2021 when the money supply saw a 27% increase in just 1 year. The pace at which the money supply was increasing fell until it became negative from 2022 to 2023 when the money supply was lower than it was the year before. But as you can see, we have since recovered. Zooming in here, the last year, you can see that the money supply growth has been positive again on a year-over-year percentage change basis. And right now, the money supply is expanding at an annualized 4.3%. It is vital to understand that every dollar is loaned into existence. Apart from the actual physical paper dollars that are printed out physically, all other dollars are just IOUs. When you put your dollar into a bank, the bank turns around and takes that and loans it out to somebody else. That ends up as a deposit in somebody else's account that then gets loaned out again to somebody else, which means your dollar's not actually in your bank account, even though it says it's there. If you and all the other people at your bank went to go get your money, the bank couldn't give it to you. They don't have it. That's what causes bank runs. Now, the reason why that's important to understand is that every dollar that exists creates more demand for more dollars in the future because dollars are loaned into existence as debt, and debt has an interest rate. So at some point, that debt needs to get repaid. Usually it gets repaid with new debt, but there's an interest that has to get paid along with it, which means more dollars eventually have to be created, which is why you see charts like this, where the money supply only grows over time, and you rarely, if ever, see this chart go down. And it's important to note it didn't even go down enough to compensate for all the printing that happened prior. So, who's doing the printing? Where is it coming from? Most people assume it's the Federal Reserve always doing this, but that is not the case. If the Federal Reserve was doing the printing, their balance sheet would be increasing, like happened here and here and here. When this line is going up, it means they are doing money printing. In other words, there are assets that exist in the financial system, like US Treasuries. The Federal Reserve prints up some dollars, buys those treasuries from the financial institution, keeps the treasuries. Now the financial institution has cash that they can go do whatever they want with. That is money printing. It is injecting cash into the system, but that is not what's happening right now. Right now, their balance sheet is declining, which means that on net, they are actually withdrawing some dollars from the system. Because as the debt that they hold on their balance sheet gets repaid, they're taking some of those dollars, lending them back out, but not all of them. Some of them are being destroyed, ceasing to exist. So if the Fed's balance sheet is going down, they are doing quantitative tightening. That is money destruction, not money printing. Now, guys, if you're concerned about everything that's going on in the markets right now, and you're not sure whether this money printing is going to spark a melt up in asset prices, whether the tariffs and uncertainty and economic risks are going to cause a massive recession and crash, and I invite you to join me at my Black Swan trading event. It's happening tomorrow, Thursday, June 12th, 7 p.m. Eastern Time. This is a completely free event. I'm going to cover how I use black swan trades to profit from unexpected and surprising events. I'm going to show you how I use trades like this to take home returns like 1,700% in 11 days from an event that very few people expected, and why I think that this may be one of the best plays to get into in the market right now. I'm even going to give away a signed copy of the Black Swan signed by Nassim Nicholas Taleb to somebody on the call. All you have to do, click on the link in the description below, register for the event, and show up for the call. This event is happening tomorrow, Thursday, June 12th at 7 p.m. Eastern Time. As always, attendance is completely free, but because I'm hosting it on Zoom, spots are limited, so don't wait until it's too late. Sign up with the link in the description below, and I look forward to seeing you there. Now, one note about the Federal Reserve's money printing, because I can hear the comments already, they don't actually do money printing. The Fed injects reserves to banks, and banks do the actual money printing. If the only thing that ever happened was banks, without the Fed, doing their lending money into existence, operating, printing money, what you would see is a natural expansion and contraction of the money supply, because banks wouldn't be able to continually do this into perpetuity. If they tried, eventually there would be a bank run and that bank would collapse, which would again contract the money supply. The only reason we have an ever expanding money supply is because when banks get into trouble and they've overprinted, and then you have the contraction of the money supply that's supposed to happen when that debt starts to get paid off and defaults start to roll in, is because the Fed steps in and injects fresh reserves in order to replenish the money that would get destroyed, which allows the system to just continue to expanding money in perpetuity rather than ever having a contraction like we should. Which is why you get charts like this, which are the source of the money printing. This is bank credit at all commercial banks. And you can see this chart is doing nothing but going up. You can see here, if we zoom into the last year, that bank credit is expanding rapidly despite the fact that the Federal Reserve's balance sheet is still decreasing. Banks are the source of money printing. And here's the thing, this is about to accelerate. This is not going to slow down. Scott Bessent, the Treasury Secretary, has been talking openly about deregulating the banks coming as soon as this summer. The reason for that is because of this. The interest rates on US government debt. Buyers of US treasuries are evaporating. There are not enough lenders for the US government's massive appetite for borrowing, which is only going to accelerate with the coming tax cuts and spending increases. They have to borrow that difference. And with rates increasing, they need somebody to borrow from, and that's going to be the banks. Right now, the banks are limited in how much money they can loan to the US government. But the plan is to deregulate specifically that so that banks can hold more US treasuries. That way they can print more money into existence in order to loan to the US government. That will certainly temporarily help interest rates, pushing them lower, but it will also cause an acceleration in the supply of money moving much higher. And when the money supply grows, it's like a tide that lifts all boats. That's asset prices like stocks, that's safe havens like gold and Bitcoin, that's real estate, and it's also goods and services. The unfortunate thing is that wages are usually the last thing to respond to inflation, which means that people like us who own assets get to benefit from the inflation, and the people who just have a little bit of savings and earning wages, they don't even get an increase in their wages until their cost of living has already gone up. It's never even enough to make up for it. This is why financial literacy is so key, and understanding how this system works will absolutely help you prepare to make more money and to keep more money and not get robbed blind by the system. I've spoken about this before, but this is not the first time the United States has been through something like this. We are in the beginning stages of an inflationary deleveraging where the government will use money printing in order to deleverage itself compared to the size of the economy. They're trying to drive up the value of the economy through money printing, tax cuts, deregulation, and they're trying to pay for all of their expenses through inflation rather than real debt. This is exactly the playbook that went down from 1940 through 1980 that drove interest rates up. But you see, there were periods of time where interest rates fell. It was volatile along the way. And so if you want my help and you want to know my plan to prepare for protecting my portfolio and profiting from these unexpected, uncertain, surprising events, please don't forget tomorrow, my Black Swan trade event, Thursday, June 12th at 7 p.m. Eastern Time. The link is in the description below. I'll see you there. As always, thank you so much for watching. Have a great day.